Hi guys, welcome back to another lecture. I hope you guys have had a look at the past lectures, you've practiced, you've gone back on your charts. I hope for those of you who have access to market profile, I hope you've gone back on the profile. And if for whatever reason you don't have access to a TPO chart, let me know. I have this one available for MT4. It is one of the best looking TPO charts you're going to find on the market. TPO costs money for sure. If you already have it, great. It's just that, in my opinion, I always think when it comes to trading, you don't want to waste too much money on acquiring too much stuff. So if you can get a TPO chart that's cheaper, that's going to do the same thing that a lot of the other ones do for $40 a month, $50 a month, $100 a month, $400 a month, then why not? Right, it's an option. Anyway, but that's not what I wanted to talk about today. Right, so today we're going to jump into the next lecture and we're going to talk a lot more about process. Right, so how you do things step by step. I've hopefully delivered quite a lot of information over the past 4 lectures, and you should already start to get to grips with what's exactly happening on the profile. One of the things I want people to understand is that it's not any different, right? So whether you're using a profile or using a candlestick chart, the basic underlying principles of the fact that the market will seek market orders. It will seek limit orders. It will seek stop losses. Right? So in effect, it will look for orders. I think for a lot of new traders, understanding what order types are is the issue. Everyone would trade so much better if they understood what the principle around order types. What do I mean by that? So we know that in the market, there are buy limits, they're market orders. Or let's say they're limit orders. I say buy limits. They're limit orders and they're market orders. Limit orders would consist of buy limits and sell limits, or some combination between a limit order and a market order, right? So there are not going to be too many different order types. There are different order types beyond those, but that's not something that retail traders are going to encounter. That's more for the quant guys, algo guys, and so on, right? People who are going to need these type of orders. Of course, you've got icebergs, which again are just concealed orders, really, and they will feed into the market once a set of orders have been triggered. This effectively allows for the larger entities to be able to conceal their position from essentially those HFT or predatory type algorithms or traders. So in a nutshell, we don't have a lot to look at, to get our head around. So let's go through these, right? And again, I'm just reinforcing the points here. And I know for those of you who are still with me through the lectures, I know you guys are going to make money, right? I can tell you with a high degree of confidence that you're going to make money because you've already made it to lesson 6. So you're going to make money because you're already taking on board the information and you're preparing yourself for what will be a change in your trading journey. I know this because it happened for me. So I know it's going to happen for you. And I've been doing this now for a very long time. And I'm so grateful that I came across TPO charts and market profile. Because if I hadn't, the basic understanding of risk management would have been all over the place. Yeah, I wouldn't have a lot of high probability scenarios. We're gonna look at this in a holistic way. And the good news about the profile is I can stay on the right side of the chart. What do I mean? It means I can look at dynamic price development and teach you guys how to do this without necessarily always going to the left-hand side of the chart to tell you, okay, look what happened here. Yeah, it's obvious. We can see what happened here. I might need to do this in order to give you some context, but I can still show you and tell you what I expect from the right side of the chart. And not a lot of people that are going to teach you to trade doing this. It's just not going to happen, right? Because no one likes being on the right side of the chart because that means that you've got to make a call, right? And it doesn't matter if you're right or wrong, but a lot of people who tutor a bit egotistical. We're all egotistical to a point, but some people are just super egotistical. And as a result, they're very afraid that their decision is going to be considered wrong. You know, I run a podcast, right? And I talk to traders who are 7-figure traders and upwards. And all those guys, bar a few, are always scared to give an opinion. I often ask a trader, you know, what do you think about this? Or what do you think this? And they're like, you get this really cop-out answer. No one wants to give an opinion. Right, so even for successful traders, they often don't want to give an opinion because they're scared that if the opinion doesn't go right, the toxicity of the internet is going to come after them. But look, who cares? If you're doing well as a huge trader in your trading, whether you're a 6-figure a year trader, 7-figure, 8-figure a year, 5-figure a year trader, the fact is, if you're a figure a year trader, you're pretty much where you need to be. Now it just becomes a question of scaling capital. Right? That's a different problem I have. But if you are a negative figure a year trader, then you've got a lot of work to do. If you are a 4-figure a year trader, then you're going somewhere, right? You're getting there. Now's the time to just look at scale. How can I get bigger? You're a 4-figure a year trader because you're probably trading smaller sizes, and that makes sense, right? But as soon as you start becoming a 5-figure a year trader, you're talking about a paycheck. Your trading is able to pay you a wage, right? And one of the things that always astonishes me is when people say, oh, it's unrealistic to achieve 5% a year in the market. Oh, it's unrealistic to think you can trade and make money consistently. What the hell are people talking about? There's so many people who make 6 figures a year, every year. They had a starting capital, but people pretend like every year they got to deposit 1 million in their trading account to make 6 figures a year. That's it. That's the assumption most people make, is that, oh, every year you got to put 1 million in the account to make a certain percentage gains a year. That's not how it works. Everyone starts somewhere. Some people might start with 100 grand. Some people might start with 50. Some people might start with 20K. It doesn't matter. People start with what they have available and they try and grow that. So some people start with 100K in their trading account. And then at the end of the year, they've got another 100K. Right? They made 100K a year. So what now? Right? They can't do that next year? Of course they could. As long as they've got an edge, they can accurately calculate how much they're going to potentially make based on what the edge is delivering today. So what I'm trying to say is that don't be afraid to make money. I think a lot of people are just scared. It's like, oh shit, this is going to end. It's not possible to make money consistently. So why are you here? Why are you doing this? If you don't think it's possible, then why are you doing this? There are a lot of traders who make 20K a day, 50K a day, 100K, and I understand it's all relative to what they can deploy. But equally, there are traders who started out with 5K, 10K, 2K, 20K, and today they got 7 figures. How did that happen? How did that happen? There's some of you who are listening to this now are following some of these traders. How did they get there? That story seems to be very opaque, right? And some traders are just, they're just, it's just a scam, right? Some are just doing other nefarious things. And I think a lot of us are running into those type of traders, and less people are running into traders like me who trade for a living, Less of us are running into these kind of traders. And the more you run into that kind of trader, the less you're going to feel it's possible to do, because at the back of your mind there's something telling you that, this guy is just consistently showing profits for 100K a day, 60K. Like, when am I ever going to get there? And you've been following him for 3 or 4 years and you're just not getting there. You're doing the same things. You're trying to put in the same type of capital that you're imagining this trader could potentially have, but you're still not getting there. So you've got to start to realize there's a problem. There's a problem somewhere. There's a problem with perhaps what they're doing, the model, and I won't even say it's that they got more money at play, because sometimes that's not even the case, because I don't know a lot of people who are retail traders who would come to the market with, say, £1 million that's not managing a fund. Not many, right? So the bottom line is that if a lot of traders have trading accounts that are between 5 and 6 figures, right? Because again, you have to think about the other implication of having a larger account. You're not covered in any kind of compensation schemes. So you're only going to be covered for a certain amount, especially if you're in the UK, for example. If you're in the US, I don't know. But I get the feeling that equally there has to be a lot of trust between you and the institution to have a lot of capital in there. I mean, people who remember the MF Global crisis would agree with me, because people lost millions in that, and it was a bit of a struggle. So anyway, call a spade a spade. We need to start to understand that it's possible to make money trading, and it's a question of scale. You need to have you have to scale quickly. So in other words, try and get as much money on the table as you can, and then find a strategy with an edge, right? And that's why I'm here. I'm trying to give you something that will be an edge. I'm giving you the tools that you can build multiple edges if you want. And then you can assess which edge is giving you the most, and then you can start to go with that. And despite all the knowledge you might have acquired here, you might only find 1 or 2 things that you want to use that are going to work for you. Right? You don't need to be able to digest everything, just 1 or 2 things. But if I give you the entire wheel, you will understand what you need to do with it. And don't be afraid to make money. Right, so I digressed a little bit, but it's important to have these conversations. That's why you're here, is for me to give you an education as best as I can, so that you can help me build this community that I'm trying to build. That's about realistic trading. I'm not about the fake stuff. It's about realistic trading. Anyway, we're talking about orders. So limit orders are going to be in the book. So these are going to be visible. So if you're with an exchange, for example, you'll see these, but these are orders that traders place. They're passive. They only get activated if a price is traded. And then we got the other type of order, which is hidden, right? I call it hidden because no one knows it's there. The only person who knows it's there is a broker. And that's stop orders, right? Stop orders are essentially instructions to the broker to say, look, if the price gets here, I would like you to take an action. And that action is usually going to be an action that will take me into the market or take me out of the market. So in other words, it's a market order, right? So a market order is something that gets executed at the time. So it takes the price at market at the time you tell it. Whereas a limit order would sit at the bid and at the ask, but in reality, a market order is something no one knows is about to hit the market. It's instant and it comes out of nowhere. Those are the most dangerous orders, and those are the orders that generate the most liquidity. Because guess what? A limit order can be manipulated. I could put a limit to buy, let's say, 20,000 shares of Apple. But then as soon as the price is about to hit that limit order, I can just pull it, I can just cancel it. Now that limit order is gone. So that's no longer liquidity for the market anymore because it's gone. I've just cancelled it. On the flip side, if I have a position, I've got no choice but to put an order to take me out of that position where my losses exacerbate. And if I don't, I can get margin called, which will lead to another market order to take me out. So once I have a position in the market, the situation gets to be a little bit dangerous. And that's what market orders do. They bring that liquidity in because it's a guarantee that someone who has a position has a point where they're going to get kicked out of the market, whether that's via margin call or via stop loss order. One way or another, the market is going to remove you. If you're making a profit and you want to get taken out of the market at a profit, then you put a limit order because you're basically saying, look, I want to sell now to someone else at a limit to realize a gain. Right? That's different. Right? So we got to get to grips with this. So we know that limit orders are kind, in my opinion, they're a bit of fake liquidity. They can somewhat create a level of support and resistance if the market trades into them and they're real limit orders and someone actually wants to buy at those levels. And it's because of that is why we look at volume as part of my trifecta. right? So a lot of the stuff I'm telling you wasn't arbitrary. I didn't think this crap up in my head, right? Just out of nowhere. I did this based on a sound understanding, the amount of time that I put in to look at the market, understand it when I was in institutions, the time I put in to understand what the institutions were doing, the time I put in to understand what other traders were doing when I was in that position to be able to see trader positions. I wanted to understand what was going on. And based on that knowledge that I accumulated over a number of years, I came to the conclusion that I need a trifecta. I need volume, time, and liquidity. These were going to be the three most important things to me, because that's what I saw was what algorithms or pricing mechanisms were looking at. So volume, where the bids stacked in the past, right? If we see bid stacking, which is a normal distribution, is basically indicating that there's a lot of volume within a very tight range. And that area has to be an area of reference, right? The market will normally move from it, or it will come back and retest it and move again. And that's because this is the only place we can guarantee that there was action, right? Because we can see that there was a lot of volume there, the market moved. So there was actual trading going on. So these are the most legitimate parts of the market. Within this order flow move, right, within this big flush that we can see, there's going to be all kinds of stuff there that's not real. There are going to be fake limit orders that were put in and pulled out. There's actually going to be places where no trading took place, where essentially there was one contract traded here and then the next contract traded here, right? And then we needed to come back and create some additional liquidity. It would have been a mess. You can't discern much from these kind of days. All we know is that the market opened and closed significantly higher out of buying that likely came from a place of consolidation or high volume. Really simple. So because I know that this is high volume and a lot of traders have actually traded here, and a lot of orders have been converted from a limit to market orders here, it's a good indication for me that it's an area that someone thought was important. It's an area of reference. I don't care about anything else, so this is all I'm going to look at. That's the first thing. So that fulfills my volume trifecta. The second thing is my time. Now I know that, of course, people come into the market at different times, but they're going to be significant times that matter because it's the open of a major center. So it could be Tokyo, it could be London, it could be New York, it could be Chicago. So it could be a lot of different venues where trading is centered around, right? Or major time zone where a lot of traders live in that time zone. Who knows, one day Florida's time might become significant, I don't know. But bottom line is that for now, London, New York, Chicago, Tokyo, those 4 times are going to be significant for me, and I need to pay attention to what the market does at those times. Happy weekends, by the way, guys. I know we're coming up to the weekend. It's been a great trading month. Super excited we're getting a break on the weekend. End of month weekend break. Really good to have these. We don't have them a lot, so it's good. Looking forward to unwinding. So I hope you are too, but I know you guys would have a weekend of study, or had a weekend of study. So yeah, hopefully it was fun. Anyway, back to what I was saying. I just thought I'd drop that in there, by the way. Anyway, so the time part is crucial, right? I want to discern that. And then we got the liquidity part, and this is the part I've been emphasizing a lot, especially over the past couple of lectures. Don't worry, it won't always be the case. We will revert to some other more interesting stuff that's going to be not only time focused, but also profile period focused, right? So weekly profiles, daily profiles, and how we can sort of integrate those. It's coming. Patience is the key here. Right, so liquidity is the next part of the equation. Now, I know that liquidity comes from those market orders, right? Because there's no liquidity if you essentially can't find anyone to take the other side of your trade. If you're on an exchange, you need to be able to match your trade with someone else. And if you can't do that, then there's essentially not enough liquidity. So the market will always look for that in order to be able to create the best possible scenario for the vast majority of traders. It's just that a lot of us are not really seeing it. We're not looking properly, right? But the market is facilitating in a way that's going to benefit a large number of traders. Now we understand that the maker-taker model, obviously there's a small amount of makers, large amount of takers, and that's understandable. People outnumber institutions, and that's what creates the market. So these guys are always going to be able to be in a more commanding position to hold larger inventory than, say, a retail trader. But we don't care. If I know that an institution has just filled a lot of market orders, i.e. they've run a lot of stops, right? So they've taken orders that are stop orders and they're just instant market orders, then fantastic, right? If I have that information and I'm willing to trade alongside these entities that have just done some really big business, not a problem. So that's why that became a third part of my trifecta, because again, or the second trifecta, which is the third, again, I put it in there because I wanted to be sure I understand that this is what's going on. I needed to be able to do something that worked. That's right. So I have liquidity there because I know that that's going to be an important part of what calls the next move, higher or lower, regardless of the time frame. But none of these can just be looked at in isolation. But we can build models that have edge, i.e. they edge, by edge I mean 50% of the time you're going to win, right? Well, let's say, actually I'm wrong. So let's say 51% of the time you're going to win, so you have an edge. Because now, how do you convert that edge into profit? If you know that you can achieve a coin toss in the market, right, which is heads, tails, 50-50, or let's say 49-50, because that's really what a coin toss is, right? Let's say you can achieve a 50-50. Then really, if I can push that to a 51, 52, 53, 54, 55, then I have a massive edge. Because all I need to do is be able to achieve a risk reward, which is a 2-to-1, and I have to be able to control the drawdown. That's another area that people don't talk about a lot, is how do you control drawdown? And when we come to the risk management side, I will show you how that's possible to manage drawdown so it's not excessive. And typically the way people trade, especially on an intraday basis, will essentially mean that they exacerbate their own drawdown. And there's ways to do it so that's not the case. Because if you exacerbate your drawdown, then you're never going to be able to, you're going to get this Monte Carlo scenario where you get a string of losses, even though they might be smaller, but you get too many in a row, and depending on the amount of capital you have, you might not be able to continue to grow exponentially. So if you're this person who wants to take a slightly smaller trading account, let's say 5 grand, 3 grand, 4 grand, and you want to be able to get that to say like 10 grand as an example, right? Then you need to be able to have very low drawdown. So reasonably somewhere about 10 to 15%, because then that reduces the, effect that you're probably going to hit some kind of massive drawdown. And hopefully, if you've assessed this part of your strategy, you won't achieve that max drawdown in one go. You will probably draw down a little bit, go up, draw down a little bit more, go up, and draw down. And then at some point, you're going to get bigger drawdown. So you get that 15% floor, and then you're going to probably skyrocket it again and go from there. So you want to control that. And the only way you can do that is, well, there are multiple ways. We'll come to that. But one of the most common ways is you got to trade less. And if you want to trade less, it means that you need to find opportunities that are very high probability, but they perhaps don't occur that often. Whether it's in the intraday, whether it's in a daily or weekly frame, that's where your probably head's going to be. But we'll come to that. I'll show you exactly how that works. So hopefully we understand why the trifecta exists, what we do with it in terms of what we're thinking about, liquidity, time, and we're thinking about volume as those three cornerstones that we always want to be considering when we're dealing with trading in general. If we understand this, we're already 90% on the way to being quite successful. So let's take a leap back and let's talk about how this looks like process-wise. So my first step would always be, from a process, is to look at a slightly larger profile, right? Or a slightly larger period profile. So take, for example, a weekly profile. Now, some of you already seen me do this assessment in the previous lecture. If you haven't, go back to the previous lectures, you'll see me do this. But start with a weekly profile, because what does that do? It provides some context. So let's say, for example, what we've seen, right side of the chart. Let's talk. So we've seen what would have been an obvious high for liquidity, and then we've seen a run of those weekly stop losses, right? So anyone who had a buy stop order here got triggered, and those became market orders, right? So we had a solid close up. We took some of the orders that were sitting at the daily high, because I'll tell you what a lot of traders do. This is quite common, is that when we get these big days and we get a close and we get a gap in value, most traders will start to short instantly, but they'll do it with tight stops. With the anticipation, if you get a decent run, you're looking at 5, 6, 7, 8 to 1, which is what the market likes to sell as achievable. Obviously, we will soon start to see why those kind of RRs are probably not achievable, and they're going to create a lot of churn and burn, and you're going to get much higher drawdowns than you'd like. Other people have creative ways. They want to create this by, they say, well, look, I just scale in. So essentially I take one position, let's say I start with a 1 lot, and then I progressively add, say like 1/5 of a lot, right? So 20K base position if you're trading FX. And then I might go in and I add 1/10 of a lot, a 10K base position. So I keep doing that progressively. Then I should build up a big enough position, and then I can break even my original 1 lot, and then the whole market keeps going down and down and down on a longer time frame. And then all in all, I've already got like 30 ticks of risk. But now the market is down 500 pips. Makes sense when you think about it that way. But the one thing they're missing is volatility. So your market could be going down, correct? But then it could have a big reversal, clean out all your break-even stops and all this fancy money management you're trying to do, and then continue in direction. What are you going to do about it? Because your 1 lot position is where it's all riding on. Because the moment you start to add, you've got to find a point where you're going to break even on that 1 lot position. And I'm going to show you typically money management techniques out there. And I'm going to show you this one and how it could go wrong. But because I know traders do that, I know they do eventually put these stops really tight, and then they like to fade the end of the day. It's my assumption that there's going to be another stop run above those highs before we collapse. So I know that market isn't going to go all in one go. And I also know that a lot of traders, when they see a big trend week, they make the assumption that the market's going to break and continue higher. So they'll get long, and then they'll put their stops trailing. So they might get long here, and they might put their stops, say at value low for the week, and then they're looking for it to push higher. So what you get is this big underpinning weekly range, right? With a lot of people getting long at a high and then the market breaking down. And what does that do? People panic when they don't see the market going in their direction, and they're like very deep in a loss. They'll start to sell. They'll start to essentially get out of it. So they're going to hit market orders, right? Because their stop loss is down here, but the market's now moving, and they only put a stop loss down there because they're saying, I don't want to lose on this trade. I want to get long because everyone says I should trade a long time frame. So I'm going to get long, but then I'm going to put my stop at 290 pips away. And then I'm going to look to catch about 100 pips, and that's a 0.5 risk reward. But I'm going to get more of these right. So I'm going to get long here and put a stop loss down here. It would sound like wisdom until that shit blows up in your face. And that's what's going on. So if you can imagine all the bad practices that you can think of a trader does, you can start to imagine where all their liquidity is going to be. So based on that explanation I just gave you, we know that there are going to be stops below the weekly low. We know that there's going to be a run on stops above the weekly high. We also know that there are going to be a hell of a lot of market orders generated as we start to break under the weekly close, right? Because people are panicking that this was supposed to go straight away and they're supposed to get that little small profit they were trying to eke out, right? They probably have a lot of weight because traders who do that are almost always oversized. So you get traders put in 20 lots, 10 lots, 50 lots at these levels and then expanding it and having 20K, exposing their entire account to loss just to make 20 or 30 ticks in the upward direction. So you're going to get those traders. So as soon as it starts to go lower, they're going to start to trim those positions. So they're either going to trim them or they're going to get rid of them altogether, and then the whole thing's going to start to cascade. Right, so you're going to get that. So we know that there's going to be liquidity here. And when we look at this profile of the week, we can see that there was a bit of a bulge, right, which is a bid stack, right? So it wasn't a normal distribution, but within the value area, the distribution was fairly normal looking. So we know that, if anything, the buyers that have the best possible position this week would have been sitting here. So this is technically the midpoint, and then we got the value area, which is the fairest prices, right? So they're going to be around here, and then we have the mode price, which is the fairest price. So we have the expectation the smart traders who are going to be long-term bullish are going to buy if the market trades into the fair price, and they're going to have their stops below value low or any recent midterm low. So let's split this profile and we take a look. So where can we see a midterm type low, right? So within the week where the low is within the value or the fair price, that's the V period low, right? What time is significant? So if we look at V period, that was 0800 start daily profile, because each of these rotations are daily rotations. So this is the day, 0800 on the day. This is that profile. These are 4-hour rotations, my bad. So 4-hour rotations. So this was an 0800 start. So that takes us to about 6 a.m. So this is a 6 a.m. bar of a given day. So we know that 6 a.m., if this is a 6 a.m. bar, it's going to be 6, 7, 8, 9, 10. So essentially till 10 p.m. So that's 6 till 10. So within 6 till 10, we understand, oh, sorry, did I say 6 p.m.? My bad, 6 a.m. So it's still 6 a.m. till 10 a.m. We know that the London session is going to come within those times. So we're going to get pre-London and London, which makes this low quite significant because it's in the London session and it's on cable, which is a UK asset. So I'm going to be paying attention to this low, right? Because I know there are going to be a lot of stops here, because that is what the smart traders would do who are going to try and get long. They're going to have liquidity down here. So if we close this, we will understand that this has got to be a really strong level, because only the smartest participants and the most skilled and knowledgeable are going to trade from this price if we trade back down there. If they're wrong, their stops are going to be here. So the stops here are less likely to generate a rally. They're more likely to generate forced liquidation. I want you to think about that statement. I want you to take a minute or two and think about that statement. What's the difference between a stop hunt, which draws liquidity into the market and causes it to revert back to the mean or come in the other direction? And what's the difference between a stop order that leads to a cascade where we just get the stops triggered and the market just collapses? Well, one of those orders is going to be pretty massive, and it's likely to belong to someone who's just going to dump a lot of weight to get out of the market. And those tend to be much larger entities. So these levels are going to have stop orders that potentially can't be saved, right? So they're going to be the ones that are going to get busted, and they're going to keep adding fuel to the fire. And eventually we're going to go much, much lower, maybe even take out a weekly low. So these stops are less likely to generate the kind of liquidity that's going to lead to a move higher. They're more likely to generate the kind of liquidity that's going to make a move lower. And hopefully we're going to see this in the next coming days as this market develops, right? And I'm hoping it occurs, right? I'm saying that there's a high chance that if we trade the S period low, we're going to go down. And if that happens, I'll have the opportunity to show you exactly what happened at that level. And if it doesn't happen, it doesn't happen. I'm not always right. These ideas are not always going to be right. We could come back and test this level next week and then bounce off that and continue higher. That will be a trade opportunity that you might want to look at. But I'm saying that those kind of trade opportunities are less interesting for me because I understand that this level's been tested before. And if it's coming back down here, then it means that these bids are not holding very well. Right, so we just got a snap reaction because there are traders that know what I know, but I also know there are traders who are going to stay very tight. Those same traders are not going to want to risk even the entire value area. They're going to stay tight because they can easily see that the next bid stack is down here, which means the value area low could easily be lost. They're not going to risk that. So they're going to position here. And we also know the more ambitious traders who are going to have long-term bullish ideas are going to position below the weekly low, right? Because they might be thinking this market's going to go higher. But these tops, you're going to get a lot of differing opinions because they're market tops and people want to sell them and people say, well, on these breakouts, they're continuations. So there's going to be a big contest at these levels. So the market's bound to get a little bit volatile. But what I can always rely on from a process point of view is step one, am I seeing a run on stops? Because those market orders tend to have more of an impact because when they get run, they get handed over to the traders who want to take the other side of that trade to go short. There's a reason those stop orders got run. So the people who are defending at the bottom of the market are not the likely candidates to win. And we can see that time and time again. And I'll show you other examples on the left side of the chart because I haven't got a choice. I've given you all the current information I can give you this week on cable. I've literally somehow given you some kind of trade signal, whatever, right? But that's how trading is, right? We can look at the right side of the chart, make a plan, put the trade on, and then see where it goes, if it's at the level we're considering. Because I have this information doesn't mean I need to take a trade. It just means that I'm aware that for my first step of my process, the market is positioning for a downside move. Okay, let's take a breath. I'm going to expand this out. So how did this play out in theory? So everything I've said, if there's some of you who are still in doubt about what I'm saying, that's okay. I'll explain it to you. So we see the open, we know there's a gap in value. My philosophy is mind the gap. Don't trade against gaps. You see this, step away. Wait for it. You're likely going to have it filled. So what did we do? We opened the week, pushed higher, and then we failed, right? And then we came back down in an 0400, which would be 0200 London to 0600 time frame. So this would be a pre-London time. As we stepped into the London time, which will be this one here, which would have been an 0600 to 10 a.m., this was the London move. So we understand that we've just seen what looks like over 1, 2, 3, 4, 5, 6, 7, 8 periods, a stop run. And we can confirm that to some extent with the aggressiveness of the I period. Let's think for a second how many rows were occurring. So each of these rows is 5 pips. 5, 10, 15, 20, 25, 30, 35, 40. So it's about 40 pips here. And if we look, B period and A period were the only ones to match that. And then we had this 1, 2, 3, 4, 5, 6, 7, 8. That's already 40, 9, 45, 50, 55 pip range coming out of a pre-London session and then closing back into the weekly, back under the weekly low. That's telling you something. We bounce off it and then we break again. We take out the London session. So this would have been 6 to 10. So we took out the London session low on this given day. And then we started to push low. And then we had a solid close under the opening price for the week, right? And no doubt this would have been an Asia session low. And this would have already gone into Monday. So we're closing under Monday's low. There's a problem. And we're heading into a gap. That was why in my previous lecture that you watched, I said to you categorically that I guarantee you we're going to go lower and we're going to fill the gap. And I told you there was a 100% guarantee that that was going to happen. If you don't believe me, go back and watch the other lectures. I said it. And I didn't just say it. I said it was a 100% guarantee. That's why I was so confident. Is because you don't see these setups too often where it's so blatantly obvious that we've seen a run on stops and then we get a confirmation in what would have been a 10 to 4, which would have been a 10 a.m. to 4 p.m., which would have been a NASDAQ Chicago period, 4-hour period that's ended up closing lower. No one's going to want to buy this. That's the bottom line, right? So we're at that point where we say, okay, well, there could be a draw of liquidity at Monday's low. But that is not confirmed because we don't necessarily get a recovery and hold even above the 50% level of the K period print on a 4-hour frame. So immediately, if you can get the week's opening price, that would be a good sell point, and then you can drive for the gap. Well, no shit, that's like 104 pip run. And that happened quickly. And what did I say? I said we're going to fill the gap and likely trade the fair price before we get a recovery. And I said we're going to get a recovery because we know there's a bid stack down here, and these are professional traders who are likely to defend their position or put in new orders in order to get a nice swing to the top. So those swing type traders who like to swing out of these big levels are going to get in. And then it's everyone's game at that point. Because if this level doesn't hold, what we're going to find here, we're going to find stops. And if these go, we're likely going to see a cascade. So we're back to that point. Right, so this is why we want to get short when we see these kind of movements, is because we know what's happened. Okay, so now we're settled here, right? And we're building what is another stack. Now, let's say we close the week and we open and then we start to bid lower and we're trading under value low. What's that telling you? Instantly, that should be giving you some information. We're trading below the offer stack, right? And we know that this would have been created because of the scenario described to you, is that the traders who had their buy orders at the opening price, at the ending price of the week or the closing price, they got long immediately, and they were willing to take a lot more risk because they knew at the back of their mind that they were never going to follow the trade through. If it didn't move immediately, they were going to panic and they were going to start selling in major sessions. And that's exactly what we saw in K period. As the market took out the London low, those traders, those very early traders, panicked and started to sell. And that selling, look at how ferocious the opener closes are. That selling just continued, right? Went through the NASDAQ and just continued through major sessions into major opens and just continued, right? We had a big drop. That happened because those traders, their positioning was offside and they decided to give up. And a lot of their positions were eventually, so they probably sold, and then you met a big block of buyers here who thought, well, we're going to buy the bid stack. Let's see if we can make some money. I have no doubt in my mind that we could open and trade value equally, right? So we could open and go up and then find sellers and come down. So it could be a bit of a rough look. But we know that one of these scenarios is going to occur. We're either going to do what we call a value trade, right? And we're going to talk about the significance of this, later in the week. Or we're going to take an opening range lower on the week, and then we're going to continue much lower, right? And that's going to open us up to trade back into the bid stack here. So we know what we're going to do. We know how we're going to approach this. We don't need any more information, right? We already discerned all of this from just looking at our weekly profile. That's the point of process. So the actual rules of liquidity and all the other stuff on the trifecta still stay in place. But what we want to be able to see is how we're going to trade it if it occurs, right? So we didn't even need to look at a daily profile for this. But let's drop down, right? So that's the first part of the process. See if we're seeing any runs on the weekly time frame, runs and stops. Can we pick out where the liquidity is? So that will be a lesson, right? So I'll go back, look at your profile chart, try and find out, or try and mark out where the liquidity is. Right, so now we're looking at what happened. So this is exactly what we saw, right? So this big push here was that weekly level that you saw. And these 4 profiles here are essentially the week, right? So these 1, 2, 3, 4 are the week, right? So this was the first lot up that closed, and then we opened, and then we started to break down. So if we were trading this, so knowing that information that we knew, we can split that profile and see exactly where that block of trade, that K period run that we saw, that was a confirmation. So this was London, and this was that K period run, Q that would have encompassed PQ and R, right? So this is where we would have seen that. And if we can see this block, then we know that, okay, there's been big action. This is where I want to trade from to the downside. So we can improve our price slightly, say on this day in the Asia session. But we would have had to been a lot more proactive to execute that trade in the NASDAQ open, right? So this Q period here would have been the 2 to 3 p.m. window, which would have in London, that would be the NASDAQ open, right? So that would be the 9 a.m. to 10 a.m. window. And then we traded lower the NASDAQ. You could have jumped on this early because you knew that we were running stops, and this bearish action in a US major center open was likely going to lead to this price collapsing over subsequent days, because we already have the information. We know exactly where we're going. We're going into that weekly bid stack, which is what we're seeing here, and that's where we're going to bounce from. Of course, this wouldn't be a trade for most people. It's because we got an Asia run, a big drop in, and then a draw out of that bid stack, and then a move higher. So this was Asia, London, US, and then we're sitting here. And then what did we see straight after that? The market still looks very bearish because we had a draw. This is P and Q period. This is the New York Open, and this is the NASDAQ. We can clearly see that in Asia, we took a draw on those stops that are sitting in the middle of value, right? So that it's kind of between the 50% of these 4 profiles is where we start to see liquidity draws. And then today, we've equally seen NASDAQ Chicago, and then we've seen a draw on London liquidity as well. So traders are going to be positioned on either side of this. The traders who are convinced that they've seen a draw, this is the NASDAQ, Chicago, a hold, and we're bidding, right? And then we can see the guys in Asia who are probably following the bearish trend are short here, and we can see that from the E period drop. And they've continued to be short, so the market trades into this level and then sells out in the US session and tries to recover. Now, what do you think is going to happen if we lose the R period low? Well, it's not a genius to work out that we're probably going to open Asia pretty strongly and then we're just going to collapse. If we go higher, we're going to hit an offer stack up here, more than likely the fair price. We have a gap in value, so this is a high possibility that we go to fill that gap. In which case, what do you think is going to happen when the Asia traders realize they're sitting at poor high? Well, we're going to lose this level, and then we're going to get a draw on all those stops that are sitting between here and here. Hopefully this made sense. Well, next lecture, we'll look at a lot more stuff, but hopefully we took this breakdown and we understood. I know it can be a little bit intense, so I'm not going to push it out anymore. We'll stop here and then we'll take it up from the next lecture. Adios.